All right, so chapter 10 that we're going to be talking about today is going to be on variances. And actually, you know what? I'm going to reshare this screen. Hold on, because it's putting this onto a different screen than anticipated. I don't have time to monkey with it. All right, are you able to see the chapter 10 sales and direct cost variances slide screen now?
Yep.
Okay, thank you. All right, so we talked a little bit about variances in managerial accounting way back when. And essentially, what we're going to be talking about that's going to make it a little different this time will be a little more emphasis on um, journal entries associated and the actual accounting side. So we will be calculating some variances, but we will also be talking about them from an accounting standpoint. To that end, the textbook doesn't do an awesome job, nor do the slides on the journal entry side. So I wanted to call out that there's a couple of handouts that are posted out in um, Canvas, labeled Variance Handout 1 and 2. And one of them is like all the formulas that you'll need for calculating these. I had planned on handing that out in class today, but I do recommend downloading that and having it available just so you have like a quick cheat sheet to use um, for the formulas. It'll just speed things along and make it a lot easier. And it also talks about like qualitatively how the different types of variances are calculated, like how they relate to one another. So very handy to have that. I will print those out and give them to you in class on Friday, but just so you know those are out there. So you're definitely welcome to use those just sort of as a shortcut. Okay, so the very basics of putting together a budget, right, are that we have what are called standard costs, right? So we assume like we've made 1 million of whatever our product is, and so we kind of know what it costs for us to create those now. So we have a standard, which is the goal price or like the goal cost that we want to stay within in order to meet our budget, right? So, um, so a predetermined price cutoff that we expect to pay in general, which is, not too high, not too low. It's going to be the most likely cost that we will pay that we have achieved in the past. Okay. And you'll typically have a standard cost for materials, labor, and both fixed and variable overhead when you're producing your goods. So you use that standard cost then as your basis to compare, like, hey, did I meet my goals? And also for creating your budgets. So you can plan financially and then figure out if you're meeting those goals, right? Now, um, typically how those costs, those standard costs are assigned is by looking at past periods and what your expectations are going to be for your costs going forward. So what you've spent in the past is probably a good guide, but like say if you haven't been super efficient in the past and you want to establish like a cost standard for where you should be, then you might also look outside your company to other companies. You might also look at like what is the economy doing? Like so right now there's lots of talk about tariffs. So a lot of manufacturers are looking at tariffs and saying, hey, we are thinking that there's a high likelihood our costs will go up. So therefore, this is what our new standard costs will be. Um, and then, so they mention here in the text, like effects of weather, political climate, and other supply chain trends. Like if you know that there's another supplier coming online for something that you've had difficulty obtaining in the past, then potentially the price could be going down, right? And then once you do that, you're also essentially setting a goal, a financial goal for your production. And then that goal is going to be in terms of units at whatever those standard costs are, which will give you your total costs. So typically then when you are looking at your costs, so like the standard cost that you think you will incur for, say, a unit of labor or a unit of materials, times the standard quantity will get you the total like expected or budgeted dollar cost for that number of units, okay, for that quantity. All right, so and then what you actually pay is going to end up being the actual cost per unit times the actual quantity of units. And that's going to be then your actual price paid, okay, for that number of units. Okay. So the actual price total. So typically then, when you're looking at this, you'll have, and I'm just drawing out something here that's on one of our handouts here. So if you have your actual cost times your, whoops, hold on, times your actual quantity. You could also have on the other end here your standard cost times your standard quantity, right? So this is your budgeted amount. This is your actual amount. And the actual cost at the actual quantity, we're typically going to be comparing this to your flexible budget, okay? So we're looking at um, like say for this number of items that we're producing, this is the standard cost and the standard quantity in terms of whatever input it is you're looking at. And that can be either direct materials or direct labor here. But the difference between these two is your flexible budget variance, okay? And then somewhere in between there, you've got, okay, well, what would at the actual, sorry, this would be your, um, in between here, we've got standard cost. Like, so let's say that we use more than we planned, right? Then if we take our standard cost and we multiply it times the actual quantity, we can then figure out the difference between these two right here. So the actual cost and the standard cost for the actual quantity. This difference right here is your cost variance, okay? So the difference in overall cost between what you paid and what you expected, that is due to a difference in the cost per unit, okay? And then over here, the difference between the standard cost and the standard quantity and the standard cost times the actual quantity would be a change in quantity here, right? So this part is your efficiency variance. So the difference in cost that is due to using a different number of your input, like so maybe more units of materials or more hours of labor than you anticipated. Okay. All right. So here we've got E&O Company, and they have standard costs for creating their hammocks, right? So their direct materials cost standard, what they expect to pay, is $35 per hammock, and the standard direct manufacturing labor costs are $10, and for overhead is $12. Now, each of these, by the way, is based on a standard quantity of materials here times the standard cost per unit of materials, okay? And this one here, the labor one, is going to be the standard quantity of labor times the standard cost per unit or hour of labor, okay? And then your standard variable manufacturing overhead costs are going to be based on some fixed costs. Actually, no. So they're breaking these out here. Sorry. Just the per unit. But again, they will have a per unit here predetermined overhead rate, okay, that they will be charging out for this one. And we've done this part actually ends up being the least amount of difference in this particular chapter because we've already done quite a bit with predetermined overhead rates in prior chapters. All right. Now, let's say that they need 4 yards of nylon fabric to produce a single hammock, and they've paid $8.75 per yard for those. So 4 times 8.75, that gets them that $35 per hammock that they talked about here on this earlier slide. Okay. Now, on the next slide here, they're talking about how they reach their labor cost. It takes a half hour of labor for labor cost, and for the overhead side of it, oops, did they mention the labor on the previous one here? Oh, just the nylon. Okay, so I'm missing my slide here for labor. But anyway, a half hour of labor times their overhead rate of $24 per hour gets us the $12 for manufacturing overhead. And half hour of labor then, if we kind of extrapolate here, so there must be a missing slide here somewhere, but if it's a half hour of labor here and it's $10 total, it must be times a $20 per hour labor rate here, okay? All right, everyone following me? So then you add those 3 together and that gets you the standard cost for a unit. All right, so jumping back to variances, right? So by definition, a variance is the difference between what you budgeted or what you expected to pay for something and what you actually paid, okay? So variance analysis, which is what we're doing in this chapter, is essentially figuring out why you had differences. Were the differences due to difference in quantity? Oops, where is my mouse here? There we go. So, so cost variances, as I mentioned before when I was doing that diagram, are based on paying different cost. All right, so paying different cost per unit, okay, of whatever input it is, okay? And then a efficiency variance, again, then is based on how many units of something you used, okay? So using different quantities, okay? And between those two, you can pretty much assess you know, the source of whatever issue you're looking at. Now, when we were talking about our responsibility units chapter, we talked about how different groups in the organization would be in charge of costs for different things, right? So like your production manager on the one hand is going to be the person that is in charge of overseeing your manufacturing. And that production manager is also therefore going to be held responsible for efficiency variances, okay? And is typically most manufacturing companies will have some type of procurement or purchasing department that is in charge of sourcing all the goods for manufacturing. And that's the department that would be in charge or be held responsible for cost variances, right? So the procurement or purchasing department's goal is to make sure we meet our cost standards, and the manufacturing or production department is in charge of making sure we meet our efficiency variances. Now, sometimes the differences in cost or the differences in efficiency are not preventable, right? Can somebody think of why, like, you might end up using more of your inputs, like your direct materials than planned, and why that might not be preventable. What do you think? Why might we be not as efficient with our supplies when we are manufacturing? What would cause that?
There might be cases of spillage.
Yeah, spillage, like maybe there was some kind of an accident or a failure of your equipment, that just, suddenly we burned through a bunch of supplies. That's totally a thing that can happen, or an accident of some kind. Yep. What else might there be? Maybe you bought like a cheaper input and it was more prone to failure. So, like maybe you bought some bolts from a different company that you're using, and now you're finding that more of these bolts or whatever get sheared off, or bad casting from a batch of stuff that you got from your supplier. So, suddenly you go through more stuff than anticipated, right? So, there are situations where it's not controllable potentially, but it could just be that you're not, maybe your workers aren't being careful aligning the machines, or maybe somebody skipped a maintenance. And so the machine wasted a bunch of stuff because somebody skipped a maintenance cycle or something like that. So you have to figure out, qualitatively, ultimately, why did we have these issues of efficiency variance? But that's the production manager's job, right? To figure that out and try to make sure that it doesn't happen again. On the other side of things, you might have a procurement manager that misses their goal. Maybe there's a new competitor of yours on the market that is snapping up a limited supply of a good, and suddenly that good becomes more expensive and the price has just gone up. Or like maybe there's tariffs that are being charged because you bring something in from overseas and there isn't a readily available domestic source to avoid the tariffs and things like that. So all of those situations can play into something. Or maybe you have a positive variance, like maybe a new supplier comes online, or maybe a tariff that's been there for a long time gets removed, and then suddenly there's less cost associated with that. So it can go positive or negative, depending on the situation, and some of it's controllable and some of it's not. Now, um, so, when we talk about variance, right? When I drew that drawing a couple minutes ago, what I was doing is what they talk about in the text. They refer to it as disaggregating the variance into its components. So, like overly fancy way of saying that they're breaking down the total amount that of difference between the actual and what we expected to pay on our budget into its separate components, right? So, with respect to a budget, right? The difference between and we talked about like in our budgeting chapter, right? The difference between a flexible budget and a static budget. The dollar difference between those two is a flexible budget variance, which they show here, right? And then that flexible budget variance can be broken down further. So you always into price and efficiency, or cost and efficiency variances, okay? We're typically most likely looking at the flexible budget variance here. So in between these two, the static budget and the flexible budget, you've got a variance that is due to the change in volume, and that is the sales volume variance. And then the flexible budget difference, and sorry, the actual cost paid, right? So the flexible budget is your budget at production level. And that difference right here, sorry, is your flexible budget variance. Okay. So sales volume variance over here. Okay. Now, A variance is favorable if the actual performance is better than the budgeted performance. So if it has a positive impact on your net income, then it's favorable. So that's kind of where you break it down. And that's typically pretty intuitive to figure out in terms of like cost. If we paid more, it's unfavorable. If we paid less for something than expected, then it would be favorable, right? If we use more of something than expected, it's unfavorable. If we use less than expected, where we would save money, then it would be favorable. Okay. Okay, so talking about our hammock company. So the only relevant costs or the costs that we care about in terms of decision making are our manufacturing costs in this example. So we're ignoring all of the general and administrative costs. We're assuming that we're selling everything that we manufacture during the period, so we don't have to worry about changes in inventory levels as far as our budget is concerned, and we don't have to worry about multiple cost levels during the period that might be from bringing in beginning inventory. So we're assuming everything is, there's no beginning or ending inventories to worry about. So we're literally just looking at what's going on in this time period. And then we also assume that the usage of materials are uniform across our units, just for simplification purposes here. So we usually sell between 15 and 20,000 hammocks per month. And the number of hammocks produced, so the number of units we produce, is our primary cost drivers for direct materials, labor, and overhead. All right, so units of production is going to be our cost driver. So our fixed overhead costs are $154,000 for up to 20,000 hammocks. If we go beyond that, maybe we have to like bring on additional people or whatever, or additional factory space. Our selling price is $99 per hammock. We're going to budget for production and sales of 20,000 hammocks, but instead we only produced 18,000 hammocks here. All right. So already then we know that we're going to have what type of variance here if we have a lower number of hammocks that we're producing. So we've got our flexible budget. We've got our static budget. And the difference between those two is going to be the sales volume variance. Okay, so the difference in production, or the difference in cost that's associated with producing 20,000 hammocks versus 18,000. And so our actual quantity in terms of hammocks is going to be 18,000. We budgeted for 20,000. Okay. Now, so and static budget variance is the difference between our actual results and the amounts budgeted in the static budget. So in addition to this, right, so our flexible budget, that's the amount that we would budget at standard cost, but with our actual quantity, okay, is our flexible budget. And then over here, we've got actual costs paid. And that's going to be at actual quantity and actual cost over here. So this would also be at 18,000 units, but the pricing and the budget, or the total amounts that we have here, this is going to be like our real life financial. Whoops, L. So that's our real life one. This is budgeted at 18,000 units here. So if we take our standard costs and we revise our budget, our original budget for 18,000 units, and so we update all of our direct materials, direct labor, and manufacturing overhead based on 18,000 units, that's our flexible budget there. Okay. And then this here is our flexible budget variance. Okay, so looking here then, all right, so they did their static budget variance. Oops, sorry, going by the way up here back to my drawing so you can see this. The difference between this static budget on the far end and what we actually paid over here, this large total variance here is the static budget variance across all of this, okay? So on the next slide, they're breaking out what that static budget variance looks like. So instead of selling 18,000, so instead of selling 20,000 units, here's their budgetary amounts here for revenues. So I think they said $99 for 20,000 units. So they multiplied out that revenue times the $99. And then direct materials, the total, I think it was $35 times 20,000. Direct labor was $10, if I recall. And then the variable manufacturing overhead, I think, was $12 per unit. So multiplying that out times 20,000 units, but then they also did the same thing here for 18,000 units. And then the difference between the two ultimately in their operating income is the static budget variance. And they figure out that static budget variance on a line by line basis here. So taking the difference, 703 minus 700 gets us here. Then we figure out these are totally why would we have more direct material? I think they have these reversed actually. Well, because why would the costs be higher? Well, oh, sorry, because some of it's due to, sorry, some of this is going to be cost and some of it is going to be efficiency, but this should actually be unfavorable. They have this mislabeled in here. This one's favorable, this one's unfavorable because it's more and it's a cost. Oh, that's awesome. Ugh, okay. And then here, this one is favorable. So just that one is labeled incorrectly. Now here, this is unfavorable. They sold less than anticipated, right? Here they had higher costs than anticipated, so that one is unfavorable. Here they're lower, so that's favorable. Down here, their contribution margin is actually unfavorable here because in total they have less contribution margin here. And then down here, this one is favorable because this one would also be unfavorable because there's more in overhead costs. Wow, whoever made this slide. Ultimately, though, the bottom line is unfavorable because their operating income was lower. So when you go through here and you look at all of these, you have to consider, like they mentioned earlier in the slides, which one of the is this improving or deteriorating our operating income? So higher cost is typically unfavorable. Okay, now so in ultimately here, right? They originally had budgeted $99 in revenue per unit, and their revenue ended up, if they take the total revenue that they had for actual revenue, hold on here from this earlier slide, 1,749,000. They divided it out by the actual number of units sold and got 97.22 per unit, which is less than the $99 per unit that they had budgeted. So that's unfavorable because they're not getting as much in terms of sales. Okay, so let's look here at an example on problem number 5 in the sample problems, which is a static budget variance example. Great. So for problem 5, they gave us a whole bunch of information here. Let me size this over here and pull up a Excel sheet to use. All right, so they gave us some standard and actual numbers here, right? So, and then what they're asking us to do for this problem is to complete a static budget to actual comparison here, right? So looking at here, we had 1,000,000 units for standard. I'm going to do this because I can see they have the same labels, and then now I can see them both. And I know the one on the left is standard here. So in terms of units produced, our standard amount was 1,000,000 for our static budget. What we actually produced and sold was 20 million, so that's a lot more. And they said produced and sold. So there's two lines here, one for produced and one for sold. They're both the same according to our problem. All right, so getting started with that, the next they want to know is, okay, what was our revenue then? So let's go up here. And I'm going to put actual here, and I'm going to put static budget. So in terms of, we had for our static budget a price of $30 per unit, and for our actual budget, a sales price average of $35. Okay. Now, let's see here. So looking at our revenues here, we're going to have quite a bit more in revenue because we're going to have 20 million units here. Let's do this. So we can actually read the numbers here, put some commas in here. And all of these are going to be whole dollar amounts. So I'm just going to put that way here. All right. And then, so basically I took the 20 million units times the $35 per unit to get the revenues here. And then for the static budget side, we had 1 million units. Which gets us $30 million. All right, so our static budget variance here then is the differences between our actual and what we originally budgeted. So here we have a difference in units of 19 million. And that gets us to a revenue variance then of 670 million. Okay, so was this, in terms of units sold, was this favorable or unfavorable variance? What do you think? Is it better to sell 20 million units than to sell 1 million units?
It'd be favorable.
Yeah, that'd be favorable. I'd be excited about that. That'd be sweet. We sold 20 times as much stuff as we planned. Never going to happen in real life, but it's awesome. Okay, so, and then here, then also in terms of dollars in revenue, also favorable, right? Because we have way more revenue. And we're not assessing whether this is because of price differences or whether it's because of quantity differences. We're just looking at the overall broad difference between our static budget and our actual results at this point. Okay, Now, in terms of direct materials here then, right? So I'm going to put over here direct materials, direct labor, manufacturing overhead, and the amount per unit here. Actually, let's do this. So direct materials for actual was, okay, so we had a variety of things. Okay, so I'm going to add these together. 2 plus 1 plus 0.45 plus 0.05. Okay, so they were kind to us, by the way. Notice they told us the quantity of each of these items that were used per unit produced. So watch out for stuff like that. Like if one of these had been, oh, we used 2 metal barrels, then we would want to include $4 for that. So you have to scale. If you have like a list of materials that go into something, make sure you're including the number of each of those materials, not just the price per unit of materials on here. But here, each of those, we use 1, so that's fine. So in terms of materials, that gets us a total of, so they're saying 350. Wait, did I do my math wrong? Let's see, 2 plus 1 plus 0.45 plus 0.05. Okay, I'm coming up with 4, and they're coming up with 350. That's weird. 3. Oh no. Okay, wait, what did I do there? 0.2 plus 1. That should be. Why? Oh, it's rounding it. I was like, what the heck? Okay, yeah. So watch your Excel here. There we go. It is 350. I can add. Yay. Okay. All right, and then on this side here, then we've got 3 plus 2. Okay, so 555. And again, I'm gonna just there we go. All right. So, and then in terms of labor hours, we've got 200,000 labor hours at a rate of 1050. So let's just plug that in here. And we're going to have variable and fixed here for this. So this is variable manufacturing overhead per direct labor hour is going to be 8 cents per hour times 200,000 labor hours. Okay. So we're calculating out that cost, and then the fixed costs are 120,000. Okay. So then up here, 350 per unit times 20 million units. Okay, gets us 70 million here. Over on our standard cost side for this, we've got 1 million times 555 per unit in materials. And then for labor side, we budgeted 10,000 units here, or 10,000 hours times 950 per hour. Okay, so what's kind of problematic about using a static budget to actual, and just looking at your static budget variance in terms of costs? What problem do you see shaping up here? Anyone spot something that looks bad here? So we've got these variances here, right? Arguably having way more revenue is favorable, we said, right? But here we had 70 million in actual costs here, which is way more costs, right? All of these are way more than we anticipated. So they all are unfavorable. So if this was the only budget analysis we did and all of this says unfavorable and we're like, why were our costs so high? This is terrible. What's wrong with that? What do you think? Well, we're only looking at this from like more is worse, right? In terms of this static budget variance. So of course, if we make 20 times as much stuff, our costs are going to be higher. Like, hello, that seems obvious, right? So if that's as far as we went with our budgetary analysis, and then we're like, our cost usage sucked for making 20 million units, and all we did look, we had 64 million in more in direct materials costs than we thought. Go fire the materials purchasing person. Would that be an appropriate judgment to make? Well, no, because we expect to use 20 times more materials, right? Um, Actually, if we look at this, right, on a cost per unit, we actually paid way less per unit than we budgeted for, which is awesome. So like, so that's where like looking at your flexible budget, a flexible budget is when you take your static budget and you recalculate it based on your actual number of units that you sold. And then you recompare, right, at an apples to apples comparison so that you can say, hey, were we actually efficient in terms of how many we used or our costs here when we consider that we made 20 times as many as we planned, right? Okay, so I'm going to plug these costs in here. All of these were unfavorable here in terms of variable costs. So our total variable cost difference here, I didn't calculate that. Oh, I think I have a couple zeros missing here. There we go. That looks better. Okay, so our difference there was 456,000. And that was ultimately, we said unfavorable because all of these cost ones were unfavorable. And then our contribution margin, we ended up with um 603,544,000 in terms of increased contribution margin. So that would be favorable. We had so contribution margin, remembering that's the amount left over to cover your fixed costs and or generate profit. So we had significantly more contribution margin than anticipated. In terms of fixed costs, our actual was 120,000. We had budgeted for 75,000. So that was a difference there of, whoops, 45,000. And it was more cost, which is unfavorable there, right? And so then that gets us to when we add up our total difference here in terms of operating income, the static budget variance is 603,499. And again, operating income was favorable. At the end of the day, we had more than anticipated. Okay. Now there was an issue. Oh, good, they fixed it. Okay, so there was in the software there was an issue with that number right there last time, but they have fixed it, so that's good. All right, so we'll wrap up on that, and we will continue talking about variances on Friday. Everybody, stay safe in the snow and warm. Bye, everybody.
Thank you.
You're welcome.